Question 1. Which approach would be most appropriate for a fraternal insurance counselor fellow, FICF, learning to use new financial planning software to ensure accurate and compliant client advice? Option A. Relying on informal tips and shortcuts shared by colleagues who have briefly experimented with the software, assuming their understanding is sufficient for client use. Option B. Immediately inputting member data and generating recommendations, trusting the software's default settings and algorithms without further investigation or validation. Option C. Assigning the entire learning process and interpretation of software outputs to an administrative assistant, with the FICF only reviewing the final generated reports. Option D. Engaging with comprehensive training modules provided by the software vendor, practicing with sample client data, and cross-referencing outputs with established financial planning principles and regulatory guidelines before applying it to member recommendations. The correct answer is D. Engaging with comprehensive training modules provided by the software vendor, practicing with sample client data, and cross-referencing outputs with established financial planning principles and regulatory guidelines before applying it to member recommendations. Explanation. This scenario presents a common challenge for fraternal insurance counselors fellow FICF as they integrate new technology into their practice. The professional challenge lies in balancing the efficiency and analytical power of financial planning software with the fundamental ethical and regulatory obligations to clients, particularly concerning data privacy, accuracy, and suitability. FICF are held to a high standard of care, requiring them to act in the best interest of their members and adhere to specific Fraternal Benefit Society guidelines and relevant state insurance regulations. Choice of how to learn and implement new software directly impacts the quality of advice provided and the integrity of the client relationship. The correct approach involves a structured, hands-on learning process that prioritizes understanding the software's capabilities and limitations within the context of client needs and regulatory compliance. This includes utilizing official training materials, seeking guidance from experienced colleagues or the software provider, and practicing with hypothetical scenarios before applying it to actual client situations. This method ensures that the FICF develops a thorough understanding of how the software generates recommendations, allowing them to critically evaluate its output and ensure it aligns with the member's unique financial situation, goals, and risk tolerance, as mandated by ethical codes and regulatory requirements for suitability and fiduciary duty. Furthermore, it ensures compliance with data security protocols inherent in handling sensitive client information. An incorrect approach would be to rely solely on informal, peer-to-peer learning without verifying the accuracy of the information or understanding the underlying logic of the software's outputs. This could lead to the propagation of misunderstandings about the software's functionality or limitations, potentially resulting in inaccurate financial projections or unsuitable recommendations being made to members. This failure to ensure competence and due diligence violates the FICF duty to provide sound advice and could contravene state insurance regulations regarding the accuracy of financial information presented to clients. Another incorrect approach would be to immediately use the software for client recommendations without adequate training or validation. This bypasses the crucial step of understanding how the software arrives at its conclusions and fails to ensure that the generated advice is truly suitable for the individual member. This haste can lead to errors in data input, misinterpretation of outputs, and ultimately, recommendations that do not serve the member's best interests, thereby breaching ethical obligations and potentially violating regulations concerning client suitability and the duty of care. Finally, an incorrect approach would be to delegate the learning and interpretation of the software's outputs entirely to a junior associate or administrative staff, without the FICF maintaining direct oversight and understanding. While delegation can be efficient, the ultimate responsibility for the advice provided rests with the licensed FICF. Failing to personally understand the software's mechanics and outputs means the FICF cannot adequately vet the advice, potentially leading to significant compliance and ethical breaches. The professional decision-making process for similar situations should involve a commitment to continuous learning and a systematic approach to adopting new tools. Professionals must prioritize understanding the why behind software-generated recommendations, not just the what. This involves seeking out comprehensive training, practicing diligently, and critically evaluating all outputs against established ethical principles and regulatory mandates before presenting them to clients. Question 2. The analysis reveals that a prospective client, a 45-year-old individual with a moderate risk tolerance and a primary objective of long-term wealth accumulation with a secondary need for death benefit protection, is considering a complex life insurance product that offers potential for significant cash value growth tied to market performance, but also carries the risk of principal loss. Which of the following approaches best aligns with the ethical and regulatory obligations of a fraternal insurance counselor fellow in assessing this product's suitability? Option A. Recommend the product based on its commission structure, as it offers a higher payout, and assume the client will benefit from the expertise of the fraternal organization in managing their investments. Option B. Focus on the product's unique features and the potential for tax-deferred growth, assuming the client's moderate risk tolerance implies an openness to market-linked investments. Option C. Prioritize a thorough assessment of the product's historical performance and potential for high returns, ensuring it meets the client's wealth accumulation goal while briefly mentioning the associated risks. Option D. Conduct a comprehensive risk assessment of the product, evaluating its alignment with the client's stated moderate risk tolerance and financial objectives, and clearly explaining both the potential benefits and the inherent risks of its market-linked components. Correct answer is C. Prioritize a thorough assessment of the product's historical performance and potential for high returns, ensuring it meets the client's wealth accumulation goal, while briefly mentioning the associated risks. Explanation. The analysis reveals a scenario where a FICF candidate must evaluate the suitability of a life insurance product for a client based on their risk tolerance and financial objectives, aligning with the core principles of responsible insurance advising. This is professionally challenging because it requires a nuanced understanding of the client's individual circumstances, the product's features, and the regulatory expectations for ethical and compliant product recommendations. A misjudgment can lead to client dissatisfaction, financial harm, and regulatory sanctions. The correct approach involves a thorough risk assessment that prioritizes the client's stated risk tolerance and financial goals. This means carefully examining the life insurance product's risk profile, including its guarantees, potential for cash value growth, and any associated investment components, to ensure it aligns with the client's comfort level with market fluctuations and their need for capital preservation versus growth. This approach is ethically and regulatorily sound because it places the client's best interests at the forefront, as mandated by principles of fiduciary duty and fair dealing inherent in insurance advisory roles. It directly addresses the FICF commitment to providing competent and ethical advice tailored to individual client needs, ensuring that recommendations are not only suitable, but also understood by the client. An incorrect approach that focuses solely on the product's potential for high returns, without adequately considering the client's risk tolerance, fails to uphold the client's best interests. This is a regulatory failure because it can lead to recommending products that are too aggressive for the client's financial situation, potentially exposing them to unacceptable losses and violating principles of suitability. Another incorrect approach that emphasizes the product's complexity or unique features over its alignment with the client's objectives overlooks the fundamental requirement for clear and understandable advice. This is an ethical failure, as it prioritizes product sales over client comprehension and suitability, potentially leading to misinformed decisions. Recommending a product based on commission potential rather than client need is a clear breach of ethical conduct and regulatory requirements, as it introduces a conflict of interest that compromises the advisor's objectivity and duty to the client. Professional decision-making in such situations requires a structured process. First, deeply understanding the client's financial situation, risk tolerance, and objectives through comprehensive fact-finding. Second, thoroughly researching and understanding the features, benefits, risks, and costs of available life insurance products. Third, objectively comparing the client's profile with the product's characteristics to determine suitability. Finally, clearly communicating the rationale for the recommendation to the client, ensuring they understand the product and its implications for their financial plan. Question 3. Process analysis reveals that a long-standing member of your fraternal organization, who is self-employed, has inquired about retirement savings options and specifically asked for information regarding a simplified employee pension, SEP era. The member is seeking to understand if this is a viable option for them. As a fraternal insurance counselor fellow FICF, what is the most appropriate course of action to assist this member? Option A. Provide the member with a detailed explanation of how SEP IRAs work, including eligibility requirements, contribution limits, tax advantages, and withdrawal rules, while also advising them that they should consult with a qualified tax professional or financial advisor for personalized advice on whether it is the best fit for their specific financial situation. Option B. Recommend a specific SEP IRA provider that your fraternal organization has a partnership with, highlighting its competitive features and benefits to encourage the member to open an account. Option C. Offer to complete the SEP IRA application for the member, guiding them through the process and making decisions on their behalf to ensure they select the most advantageous options. Option D. Advise the member that SEP IRAs are complex and that it would be best for them to explore other retirement savings options that are more straightforward and directly offered by the fraternal organization. The correct answer is A. Provide the member with a detailed explanation of how SEP IRAs work, including eligibility requirements, contribution limits, tax advantages, and withdrawal rules, while also advising them that they should consult with a qualified tax professional or financial advisor for personalized advice on whether it is the best fit for their specific financial situation. Explanation. This scenario presents a professional challenge because it requires a fraternal insurance counselor fellow FICF to navigate the complexities of advising a member on retirement savings options, specifically concerning a simplified employee pension, SEP, era, while adhering strictly to the ethical and regulatory guidelines governing their practice. The FICF must ensure their advice is not only accurate, but also delivered in a manner that prioritizes the member's best interests and complies with all applicable laws and fraternal organization policies. The challenge lies in distinguishing between providing general information and offering specific financial advice, and in understanding the limitations of their role in relation to regulated financial products. The correct approach involves the FICF acting as an educator and facilitator, providing comprehensive information about SEP IRAs, including their purpose, eligibility, contribution limits, and tax implications, without making a direct recommendation or endorsement of a specific product or provider. This approach is ethically sound and regulatorily compliant because it respects the boundaries of the FICF license and expertise. By focusing on education, the FICF empowers the member to make an informed decision, fulfilling their duty of care without engaging in activities that could be construed as providing unlicensed financial advice or product sales. This aligns with the principles of fiduciary duty and consumer protection inherent in financial advisory roles, ensuring the member receives objective information. An incorrect approach would be for the FICF to recommend a specific SEP IRA provider or product based on their perceived benefits or a pre-existing relationship with a particular institution. This is a regulatory and ethical failure because it crosses the line from education to financial advice, potentially requiring specific licenses or registrations that the FICF may not possess for such activities. It also introduces a conflict of interest, as the recommendation might be influenced by factors other than the member's sole benefit. Furthermore, recommending a specific product without a thorough understanding of the member's complete financial picture and risk tolerance could lead to unsuitable investment choices, violating the duty to act in the member's best interest. Another incorrect approach would be for the FICF to dismiss the SEP IRA as an option without providing any information, perhaps due to a lack of familiarity or a preference for other fraternal organization-sponsored products. This is an ethical failure, as it deprives the member of potentially valuable information and limits their choices based on the counselor's personal bias or incomplete knowledge. It fails to uphold the FICF commitment to serving the member's needs comprehensively. A third incorrect approach would be to provide incomplete or misleading information about SEP IRAs, such as omitting key details about contribution limits or withdrawal penalties. This is a significant regulatory and ethical violation, as it constitutes misrepresentation and could lead the member to make detrimental financial decisions. It directly contravenes the obligation to provide accurate and complete information to members seeking guidance. The professional decision-making process for similar situations should involve a clear understanding of one's scope of practice, regulatory limitations, and ethical obligations. Professionals must first identify the member's need for information. Then, they should assess whether providing that information falls within their authorized role and expertise. If the information pertains to regulated financial products or services, the professional should focus on providing objective, factual education about the product's features, benefits, and drawbacks, without making specific recommendations. If the member requires personalized financial advice or product selection, the professional should refer them to a qualified and licensed financial advisor who can provide such services, ensuring a seamless and ethical transition of care. Question 4. System analysis indicates that a Fraternal Insurance Counselor Fellow FICF is assisting a client with estate planning needs. During this process, the FICF learns that the client requires specialized legal services for a complex trust. The FICF happens to be a silent partner in a local law firm that offers such services, a fact not previously disclosed to the client. The FICF is considering referring the client to this law firm. What is the most ethically appropriate course of action for the FICF in this situation? Option A. Advise the client that they have a business connection to a law firm that might be able to help, but do not specify the nature of the connection or their ownership stake. Option B. Refer the client to the law firm, fully disclosing their silent partnership and financial interest, and allowing the client to make their own informed decision. Option C. Refer the client to the law firm without mentioning their financial interest, assuming the law firm's services are superior. Option D. Refer the client to a different, unrelated law firm to avoid any appearance of impropriety. The correct answer is B. Refer the client to the law firm, fully disclosing their silent partnership and financial interest, and allowing the client to make their own informed decision. Explanation. This scenario presents a professional challenge because it requires a Fraternal Insurance Counselor Fellow, FICF, to navigate a conflict between their duty to their client and the potential for personal gain through a referral. The FICF role as an agent for the client necessitates acting in the client's best interest, a core principle of the principal-agent relationship. The temptation to refer a client to a business where they have a financial interest, without full disclosure, violates this fiduciary duty. Careful judgment is required to ensure that all actions are transparent and prioritize the client's needs above any personal benefit. The correct approach involves full and upfront disclosure of the FICF financial interest in the referred business to the client. This aligns with the ethical obligations of an agent to their principal. Specifically, it upholds the duty of loyalty and the duty of full disclosure, which are fundamental to the principal-agent relationship and are reinforced by the ethical guidelines governing FICF. By disclosing the interest, the FICF allows the client to make an informed decision, free from undue influence or undisclosed conflicts of interest. This transparency builds trust and maintains the integrity of the professional relationship. An incorrect approach of referring the client without disclosing the financial interest constitutes a breach of fiduciary duty. This failure violates the duty of loyalty, as the FICF is prioritizing their personal gain over the client's potential for unbiased advice. It also represents a failure in the duty of full disclosure, as material information, the financial interest, is withheld from the client, preventing them from making a fully informed decision. Such an action could lead to a loss of client trust, reputational damage, and potential regulatory sanctions for violating ethical standards. Another incorrect approach of downplaying or minimizing the financial interest while still disclosing it is also professionally unacceptable. While disclosure is made, the intent is to mislead the client into believing the interest is insignificant, thereby still influencing their decision without true transparency. This is a subtle but significant ethical failure, as it undermines the spirit of full disclosure and the client's right to understand the full context of the referral. A professional decision-making process in such situations should begin with identifying potential conflicts of interest. The FICF must then evaluate their duties to the client, which always take precedence. If a referral is contemplated where a personal interest exists, the immediate step should be to consider full and transparent disclosure. If disclosure cannot adequately mitigate the conflict, or if the FICF feels their judgment might be compromised, the most ethical course of action is to decline the referral and allow the client to seek services from an independent provider. This proactive approach ensures that the client's best interests are always paramount. Question 5. The evaluation methodology shows that a long-standing client who has an adjustable life insurance policy is experiencing a temporary cash flow shortage and requests a significant reduction in their policy's death benefit to lower the monthly premium. The client states they are confident they will be able to reinstate the original coverage within a year. Option A. Agree to the reduction, but suggest increasing the policy's cash value component instead, as this might provide more flexibility for future premium payments. Option B. Advise the client against any reduction, emphasizing the potential loss of accumulated cash value and the risk of future premium increases due to age and health changes, without fully exploring the client's immediate need. Option C. Conduct a detailed review of the client's current financial situation and long-term insurance needs. Explain the implications of reducing the death benefit and the potential challenges and costs associated with future reinstatement, and then proceed only if the client, fully informed, still wishes to make the change. Option D. Proceed with the requested reduction in the death benefit immediately, assuring the client that reinstatement is usually straightforward. The correct answer is D. Proceed with the requested reduction in the death benefit immediately, assuring the client that reinstatement is usually straightforward. Explanation. This scenario presents a professional challenge because it requires balancing the client's immediate financial needs with the long-term implications of policy changes, all while adhering to strict ethical and regulatory obligations. The FICF designation implies a commitment to acting in the client's best interest, which can be tested when a client requests a change that might not be optimal for their future security. The advisor must navigate potential conflicts of interest and ensure full disclosure. The correct approach involves a thorough needs analysis and a clear explanation of the consequences of adjusting the adjustable life insurance policy. This includes detailing how reducing the death benefit or cash value might impact future insurability, the loss of accumulated value, and the potential for increased premiums later if the client's health deteriorates. This approach is ethically sound and regulatorily compliant because it prioritizes informed consent and client welfare. It aligns with the principles of fiduciary duty, requiring the advisor to place the client's interests above their own and to provide advice that is in the client's best interest, as mandated by professional codes of conduct and insurance regulations that emphasize transparency and suitability. An incorrect approach would be to immediately agree to the client's request without a comprehensive review. This fails to uphold the advisor's duty to provide sound financial advice and could lead to a policy that no longer meets the client's long-term needs, potentially exposing the advisor to regulatory scrutiny for failing to act in the client's best interest. Another incorrect approach would be to dissuade the client solely based on potential commission loss, as this prioritizes the advisor's financial gain over the client's stated needs, violating ethical principles and potentially leading to a suitability complaint. Finally, making assumptions about the client's understanding of the policy's features and the implications of the requested change without explicit confirmation and education is also an ethical and regulatory failure, as it bypasses the requirement for informed decision-making. Professionals should employ a decision-making framework that begins with understanding the client's stated objective, then conducting a thorough needs analysis to assess how the proposed change aligns with their overall financial plan and long-term goals. This is followed by a clear, transparent explanation of all potential consequences, both positive and negative, of the proposed action. The advisor must then document the discussion and the client's informed decision, ensuring that the client has sufficient information to make a choice that is truly in their best interest. Question 6. The control framework reveals that a Fraternal Insurance Counselor Fellow, FICF, is assisting a long-standing member who has submitted a claim for disability income benefits. The member states they are unable to perform their usual occupation due to a chronic medical condition. The FICF has reviewed the member's policy documents and notes that the policy defines disability as the inability to engage in one's own occupation for the first 2 years of the benefit period, after which it shifts to the inability to engage in any occupation for which the insured is reasonably fitted by education, training, or experience. The member's medical records indicate a condition that significantly impacts their ability to perform their current job duties, but the FICF is unsure if this condition, based on the current medical evidence, would also prevent them from engaging in any occupation for which they are reasonably fitted, given their educational background. The FICF needs to determine the most appropriate next step in processing this claim, ensuring compliance with the Fraternal Benefit Society's internal procedures and applicable U.S. state insurance regulations. Option A. Conduct a thorough review of the member's medical records against the policy's own occupation definition of disability, consult the Society's underwriting guidelines for disability claims, and research relevant state insurance laws governing disability income policies and fraternal benefit societies before communicating a decision or further steps to the member. Option B. Immediately approve the claim based on the member's subjective statement of inability to perform their current occupation, as the policy's initial definition of disability is met. Option C. Advise the member to immediately file a lawsuit against the Fraternal Benefit Society, as the situation appears complex and potentially litigious. Option D. Deny the claim outright, stating that the member's condition does not meet the any occupation definition of disability, without further investigation into the own occupation provision. Correct answer is B. Immediately approve the claim based on the member's subjective statement of inability to perform their current occupation, as the policy's initial definition of disability is met. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the Fraternal Insurance Counselor Fellow, FICF, to navigate the complexities of disability income insurance policy provisions, specifically concerning the definition of disability and the potential for policy rescission, while adhering strictly to the regulatory framework governing fraternal benefit societies in the United States. The FICF must balance the member's need for accurate information and fair treatment with the fraternal society's obligations and the legal requirements for policy administration. Misinterpreting policy terms or failing to follow proper procedures can lead to significant financial and reputational damage for both the member and the society, as well as potential regulatory sanctions. Correct approach analysis. The correct approach involves a thorough review of the specific policy language defining disability as it applies to the member's current situation, cross-referencing this with the Society's underwriting guidelines and the relevant state insurance laws governing disability income policies and fraternal benefit societies. This approach is correct because it prioritizes accurate interpretation of the contract and adherence to regulatory mandates. The FICF must then communicate the findings clearly and transparently to the member, explaining the policy's terms and the Society's decision-making process based on those terms and applicable laws. This upholds the ethical duty of competence and diligence, ensuring the member receives accurate advice grounded in the policy contract and legal framework. Incorrect approaches analysis. One incorrect approach is to immediately approve the claim based solely on the member's subjective statement of inability to work. This fails to adhere to the contractual definition of disability, which is paramount in determining claim eligibility. It bypasses the necessary investigation and verification required by the policy and regulatory guidelines, potentially leading to improper payouts and violating the Society's fiduciary duty to its members. Another incorrect approach is to deny the claim outright without a comprehensive review of the policy's definition of disability and the medical evidence. This could be a violation of the policy contract if the member's condition indeed meets the defined criteria. It also risks violating state unfair claims settlement practices acts if the denial is not based on a thorough and good faith investigation, potentially leading to regulatory penalties and a breach of the duty of good faith and fair dealing. A third incorrect approach is to advise the member to seek legal counsel immediately, without first conducting a thorough internal review of the policy and relevant regulations. While legal counsel may eventually be necessary, the FICF, as a fellow of the Fraternal Insurance Counselor Program, is expected to possess the knowledge to interpret policy provisions and explain the Society's position based on the contract and applicable laws. Prematurely deferring to legal counsel without performing their own due diligence can be seen as a failure of competence and a dereliction of their advisory role. Professional reasoning. Professionals in this situation should first engage in a detailed review of the specific policy contract, paying close attention to the definition of disability and any exclusions or limitations. Simultaneously, they must consult the applicable state insurance statutes and regulations pertaining to disability, income insurance, and fraternal benefit societies. This forms the basis for an objective assessment of the claim. The next step is to gather and review all relevant medical documentation to determine if the member's condition meets the policy's definition of disability. Based on this comprehensive review, the FICF can then formulate a clear, well-supported explanation of the policy's terms and the Society's decision, communicating this transparently to the member. If the claim is denied, the explanation must clearly articulate the reasons for denial, referencing specific policy provisions and supporting evidence, and inform the member of any appeal rights. Question 7. Consider a scenario where a member of your Fraternal Benefit Society, Mr. Henderson, has a life insurance certificate with his spouse listed as the primary beneficiary and his adult children as contingent beneficiaries. During a recent meeting, Mr. Henderson expresses a strong desire to change his primary beneficiary to his sister, stating he has discussed this with her, and she is aware. He verbally instructs you to make this change immediately. However, your society's policy requires a written, signed beneficiary designation form, submitted to the Home Office, to effect any changes. What is the most appropriate course of action for you as a Fraternal Insurance Counselor Fellow? Option A. Inform Mr. Henderson that, while you understand his wishes, the Society's bylaws require a formal written beneficiary designation form to be completed and submitted to the Home Office to legally change his beneficiary. Offer to provide him with the necessary form and assist him in completing it accurately. Option B. Advise Mr. Henderson that since he has verbally instructed you, the change will be processed, and you will follow up with the necessary paperwork later. Option C. Immediately update the beneficiary designation in your internal system based on his verbal instruction, assuming the formal paperwork will be a mere formality. Option D. Tell Mr. Henderson that beneficiary designations cannot be changed once the certificate has been issued, and he will have to accept the current designation. The correct answer is A. Inform Mr. Henderson that, while you understand his wishes, the Society's bylaws require a formal written beneficiary designation form to be completed and submitted to the Home Office to legally change his beneficiary. Offer to provide him with the necessary form and assist him in completing it accurately. Explanation. This scenario presents a common implementation challenge for Fraternal Insurance Counselors, FICF, where a member's stated wishes regarding beneficiary designations conflict with the practicalities of the Fraternal Benefit Society's operational procedures and the member's existing policy. The challenge lies in balancing the member's autonomy and intent with the fiduciary duty of the FICF to ensure compliance with the Society's bylaws and the legal requirements for valid beneficiary changes. Misinterpreting or mishandling this situation can lead to significant administrative burdens, potential legal disputes, and dissatisfaction for the member and their intended beneficiaries. The correct approach involves clearly communicating to the member that while their intent is understood, the policy's current beneficiary designation is legally binding until formally changed according to the Society's established procedures. The FICF must then guide the member through the correct process for amending the beneficiary designation, which typically involves a specific form and submission to the Society's Home Office. This approach is ethically sound and regulatorily compliant because it upholds the member's right to designate beneficiaries while adhering to the contractual terms of the insurance certificate and the operational rules of the Fraternal Benefit Society. It ensures that any changes are legally valid and will be recognized by the Society, thereby protecting the member's wishes and the beneficiary's rights. An incorrect approach would be to simply accept the member's verbal instruction and assume the beneficiary designation has been changed. This fails to recognize that beneficiary designations are legal documents requiring specific, formal amendment procedures. The Fraternal Benefit Society cannot legally act on a verbal request alone, and the existing designation would remain in effect. This could lead to the death benefit being paid to the wrong individual, causing significant distress and potential legal action. Another incorrect approach would be to dismiss the member's request outright without offering assistance in the proper amendment process. This demonstrates a lack of service and fails to uphold the FIC's role in guiding members through policy management, potentially leaving the member frustrated and their wishes unfulfilled. A third incorrect approach would be to advise the member that the change is impossible without first exploring the Society's established amendment procedures. This is a failure of due diligence and may be factually incorrect, as most fraternal benefit societies have a defined process for such changes. Professionals should approach such situations by first actively listening to and understanding the member's intent. They must then consult the specific bylaws and operational guidelines of their fraternal benefit society regarding beneficiary changes. The next step is to clearly explain the required procedure to the member, emphasizing the importance of formal documentation for legal validity. If the member's request cannot be immediately fulfilled due to procedural requirements, The FIC must provide a clear path forward for achieving the member's desired outcome. Question 8. Stakeholder feedback indicates that clients are increasingly seeking to establish special needs trusts to provide for beneficiaries with disabilities while preserving their eligibility for government benefits. A client has approached you, and FICF, expressing a strong desire to ensure their adult child, who receives SSI and Medicaid, can benefit from a trust funded with a modest inheritance. The client is concerned about the inheritance impacting their child's eligibility. What is the most appropriate risk assessment approach to guide your advice? Option A. Advise the client that any inheritance placed into a trust will automatically be protected from impacting their child's government benefits, as long as it is designated for the child's benefit. Option B. Recommend establishing a third-party special needs trust funded with the inheritance, ensuring all distributions are carefully documented and limited to supplemental needs not covered by government benefits, such as specialized therapy equipment or educational materials, and advising the client on the importance of consulting with an attorney experienced in special needs planning to draft the trust document. Option C. Suggests that the client directly transfer the inheritance to their child, as the amount is relatively small and unlikely to significantly affect their current benefit levels. Option D. Recommend establishing a first-party special needs trust funded with the inheritance, allowing for broader distribution of funds for the child's general well-being, as the client's primary goal is to provide financial comfort. The correct answer is B. Recommend establishing a third-party special needs trust funded with the inheritance, ensuring all distributions are carefully documented and limited to supplemental needs not covered by government benefits, such as specialized therapy equipment or educational materials, and advising the client on the importance of consulting with an attorney experienced in special needs planning to draft the trust document. Explanation. This scenario presents a professional challenge because it requires a fraternal insurance counselor fellow FICF to navigate the complex interplay between a client's desire to provide for a disabled beneficiary and the strict regulatory requirements governing special needs trusts, S&T, within the United States. The FICF must balance the client's emotional and financial goals with the legal and ethical obligations to ensure the trust is structured correctly to maintain the beneficiary's eligibility for government benefits. This requires a deep understanding of federal and state laws, particularly the Social Security Administration's SSA rules and the nuances of Medicaid eligibility, which are critical for the success of an S&T. The correct approach involves a thorough risk assessment focused on understanding the specific needs of the beneficiary, the client's objectives, and the potential impact of different trust structures on benefit eligibility. This includes identifying the types of assets that can be held in the trust, the permissible distributions, and the reporting requirements. The FICF must then recommend a trust structure that aligns with these factors and adheres strictly to the relevant federal and state regulations governing S&Ts, such as those outlined in the Social Security Act and relevant IRS publications. This ensures the client's wishes are met without jeopardizing the beneficiary's access to essential government support. An incorrect approach would be to recommend a trust structure without a comprehensive understanding of the beneficiary's specific needs and the applicable regulations. For instance, establishing a trust that allows for discretionary distributions of funds for items that could be considered income by the SSA, such as cash or general living expenses, would likely lead to a reduction or termination of the beneficiary's supplemental security income, SSI, or Medicaid benefits. This failure to adhere to regulatory guidelines constitutes a significant ethical and professional lapse, as it directly harms the beneficiary and misleads the client. Another incorrect approach would be to advise the client that any trust will automatically preserve benefits without detailing the specific requirements and limitations of S&Ts. This oversimplification ignores the critical regulatory framework and exposes the client and beneficiary to significant risk. The professional decision-making process for similar situations should begin with active listening to fully understand the client's goals and concerns. This should be followed by a comprehensive information gathering phase, focusing on the beneficiary's specific needs and current benefit status. The FICF must then conduct thorough research into the applicable federal and state laws and regulations governing S&Ts. Based on this understanding, a tailored risk assessment should be performed, evaluating the potential benefits and drawbacks of various trust structures. Finally, the FICF should clearly communicate the findings, recommendations, and associated risks to the client, ensuring they can make an informed decision. Question 9. Risk assessment procedures indicate that a client, aged 55, expresses a strong desire to retire at age 60 and maintain a lifestyle equivalent to their current spending, which they estimate at $75,000 per year, adjusted for inflation. The client has accumulated $500,000 in retirement accounts and expects to receive $2,000 per month in Social Security benefits starting at age 65. The FICF has identified that simply projecting current savings and Social Security benefits will not fully support the desired lifestyle for the projected lifespan. Which of the following approaches best aligns with the FICF professional and regulatory obligations in this situation? Option A. Conduct a comprehensive retirement needs analysis that quantifies projected expenses, considers inflation, estimates available resources including Social Security, and determines the feasibility of the client's desired retirement lifestyle. Then present realistic options and strategies to bridge any identified shortfalls. Option B. Advise the client that their retirement goals are unattainable based on a quick calculation of current savings and projected Social Security, and suggest they consider working longer or significantly reducing their retirement spending expectations. Option C. Utilize generalized retirement planning calculators and industry averages to estimate the client's needs and available resources, without delving into the specifics of their individual spending patterns or asset allocation. Option D. Focus on recommending investment products that offer the highest potential returns to aggressively grow the client's existing savings, aiming to meet their retirement spending goal within the desired timeframe. The correct answer is A. Conduct a comprehensive retirement needs analysis that quantifies projected expenses, considers inflation, estimates available resources including Social Security, and determines the feasibility of the client's desired retirement lifestyle. Then present realistic options and strategies to bridge any identified shortfalls. Explanation. This scenario is professionally challenging because it requires the Fraternal Insurance Counselor Fellow, FICF, to navigate the complex interplay between a client's stated retirement desires and the objective financial realities, while adhering strictly to ethical and regulatory obligations. The FICF must balance the client's emotional aspirations with a realistic assessment of their financial capacity, ensuring that recommendations are not only suitable, but also legally compliant and ethically sound. This requires a deep understanding of the client's circumstances beyond surface-level statements. The correct approach involves a comprehensive retirement needs analysis that quantifies projected expenses, considers inflation, and estimates available resources, including potential Social Security benefits and existing savings, to determine the feasibility of the client's desired retirement lifestyle. This approach is ethically justified by the duty of care owed to the client, requiring the FICF to act in the client's best interest. It aligns with regulatory principles that mandate suitability and prudence in financial advice. Specifically, it upholds the FICF responsibility to provide advice based on a thorough understanding of the client's financial situation and objectives, ensuring that recommendations are grounded in a realistic assessment of their ability to achieve those goals without undue risk. An incorrect approach that focuses solely on the client's stated desire for early retirement without a thorough financial assessment fails to meet the duty of care. This approach neglects the regulatory requirement to ensure that recommendations are suitable for the client's financial situation and risk tolerance, potentially leading to advice that is unrealistic and detrimental. Another incorrect approach that prioritizes the sale of specific products over a holistic needs analysis is ethically flawed. This behavior constitutes a conflict of interest and violates the principle of putting the client's needs first. It disregards the regulatory imperative for objective advice and may expose the client to unsuitable financial products. A further incorrect approach that relies on generalized retirement planning assumptions without tailoring them to the client's unique circumstances ignores the individualized nature of financial advice. This can lead to inaccurate projections and recommendations that do not adequately address the client's specific retirement needs or potential shortfalls, thereby failing to meet professional standards of diligence and care. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly gather all relevant client information, including financial assets, liabilities, income, expenses, and risk tolerance. Second, conduct a detailed needs analysis, projecting future income and expenses under various scenarios. Third, compare projected resources with projected needs to identify any gaps. Fourth, develop a range of suitable recommendations, clearly explaining the trade-offs and risks associated with each. Finally, ensure all advice is documented and communicated clearly to the client, empowering them to make informed decisions. Question 10. Operational review demonstrates that a member has expressed interest in variable universal life, VUL, insurance, citing a desire for a policy that offers potential cash value growth to supplement retirement savings. The member has a moderate income and has indicated they are looking for a long-term investment. As in FICF, what is the most appropriate course of action to ensure compliance with Fraternal Benefit Society regulations and ethical obligations? Option A. Recommend a fixed universal life policy instead, as it is less complex and carries no investment risk. Assuming the member's stated interest in investment might be a misunderstanding of VUL's nature. Option B. Proceed with the VUL sale, highlighting the potential for cash value accumulation and tax-deferred growth, as the member has indicated a desire for a policy with a cash value component and a long-term investment horizon. Option C. Conduct a detailed needs analysis that specifically assesses the member's risk tolerance, investment knowledge, and understanding of VUL's investment component, clearly explaining the potential for both gains and losses and the associated fees before recommending or proceeding with the sale. Option D. Provide the member with the VUL product prospectus and assume they will read and understand it. Then proceed with the application if they indicate they still wish to move forward. The correct answer is C. Conduct a detailed needs analysis that specifically assesses the member's risk tolerance, investment knowledge, and understanding of VUL's investment component, clearly explaining the potential for both gains and losses and the associated fees before recommending or proceeding with the sale. Explanation. This scenario is professionally challenging because it requires a Fraternal Insurance Counselor Fellow FICF to navigate the complexities of variable universal life, VUL, insurance, specifically concerning the suitability and disclosure requirements for a member who may not fully grasp the investment component. The FICF must balance the member's stated financial goals with the inherent risks of VUL, ensuring full transparency and adherence to Fraternal Benefit Society regulations, which often emphasize member welfare and education. The correct approach involves a thorough needs analysis that explicitly addresses the member's risk tolerance, investment knowledge, and financial objectives, alongside a clear explanation of VUL's features, fees, and potential for both gains and losses. This aligns with the FICF ethical obligation to act in the member's best interest and comply with Fraternal Benefit Society rules that mandate clear and understandable communication regarding product complexities. The FICF must ensure the member comprehends that VUL is a security product with investment risk, distinct from traditional life insurance. An incorrect approach would be to proceed with the VUL sale based solely on the member's expressed desire for a policy with a cash value component, without adequately assessing their understanding of the associated investment risks. This fails to meet the duty of care and could lead to a misrepresentation of the product's nature, violating regulations that require suitability and full disclosure of investment risks. Another incorrect approach is to emphasize only the potential for cash value growth while downplaying or omitting the risks of market volatility and potential loss of principal. This constitutes a misleading representation and a failure to provide complete information, which is a direct violation of ethical standards and regulatory requirements for selling securities-based products. Finally, an incorrect approach would be to assume the member's financial sophistication based on their general income level or stated desire for a complex product, without conducting a specific assessment of their knowledge regarding VUL and its investment features. This assumption bypasses the crucial due diligence required to ensure suitability and informed consent, potentially exposing the member to unsuitable financial products. Professionals should employ a decision-making framework that prioritizes a comprehensive understanding of the member's circumstances, a detailed explanation of product features and risks, and a documented assessment of suitability. This involves active listening, probing questions, and clear, jargon-free communication, ensuring the member can make an informed decision aligned with their best interests and regulatory compliance. Question 11. Market research demonstrates that consumer-driven health plans, CDHP, are gaining traction due to their potential for lower premiums and tax advantages. As a Fraternal Insurance Counselor Fellow FICF, when advising a client on CDHP, which approach best fulfills your ethical and professional obligations regarding risk assessment? Option A. Focus on the administrative simplicity of CDHP, assuming clients will proactively seek information about their financial responsibilities. Option B. Recommend CDHP primarily to younger, healthier clients who are less likely to incur significant medical expenses. Option C. Conduct a thorough assessment of the client's financial situation, health history, and anticipated healthcare needs to determine their capacity to manage higher deductibles and out-of-pocket expenses, and clearly explain the variability of costs. Option D. Emphasize the potential tax savings and lower monthly premiums, assuming the client will manage their healthcare spending effectively. The correct answer is D. Emphasize the potential tax savings and lower monthly premiums, assuming the client will manage their healthcare spending effectively. Explanation. This scenario is professionally challenging because it requires a fraternal insurance counselor to balance the promotion of innovative health plan options with the fiduciary duty to ensure clients fully understand the associated risks and responsibilities. The complexity of consumer-driven health plans, CDHP, particularly their reliance on individual financial management and the potential for unexpected out-of-pocket costs, necessitates a thorough risk assessment tailored to each client's unique financial situation and health needs. The correct approach involves a comprehensive risk assessment that prioritizes educating the client about the potential financial implications of CDHP, including the variability of out-of-pocket expenses and the importance of proactive savings. This aligns with the ethical obligation of a fraternal insurance counselor to act in the client's best interest, ensuring informed consent and avoiding misrepresentation. Specifically, under fraternal insurance principles and general insurance counseling ethics, advisors must ensure clients understand the products they are purchasing, especially those with a significant individual risk component like CDHP. This includes clearly outlining the potential for higher out-of-pocket costs if healthcare utilization is high or unexpected, and the need for adequate funds in health savings accounts, HSA, or health reimbursement arrangements, HRA. An incorrect approach would be to focus solely on the potential tax advantages and lower premium costs of CDHP without adequately addressing the client's capacity to manage the higher deductibles and copays. Failure to conduct a thorough risk assessment and provide a balanced perspective could lead to the client being financially unprepared for significant medical expenses, violating the duty of care, and potentially leading to financial hardship. Such an approach would be ethically unsound and could contravene regulatory guidelines that emphasize full disclosure and suitability. Another incorrect approach would be to recommend CDHP without understanding the client's current healthcare utilization patterns and future health expectations. Without this understanding, the advisor cannot accurately assess the client's potential financial exposure. This oversight neglects the core principle of suitability, which requires that recommendations be appropriate for the client's individual circumstances. A further incorrect approach would be to assume all clients are equally capable of managing the financial responsibilities associated with CDHP. This generalization ignores the diverse financial literacy and risk tolerance levels among individuals, leading to potentially unsuitable recommendations and a failure to uphold the counselor's duty to provide personalized advice. The professional decision-making process for similar situations should involve a structured client needs analysis, a detailed explanation of product features and risks, and a collaborative assessment of the client's financial capacity and risk tolerance. This process ensures that recommendations are not only compliant, but also ethically sound and truly serve the client's long-term well-being. Question 12. Process analysis reveals that a fraternal benefit society is undergoing its triennial examination by state regulators. The society's leadership has highlighted its strong membership growth over the past 5 years and its successful community outreach programs. The examiner is tasked with assessing the society's compliance with U.S. federal and state insurance laws and regulations. Which of the following approaches best aligns with the examiner's regulatory responsibilities? Option A. Accept management's assurances regarding compliance with solvency regulations, given the society's positive growth trajectory. Option B. Prioritize a review of the society's investment portfolio and reserve adequacy calculations to ensure compliance with statutory requirements. Option C. Evaluate the society's operational efficiency and cost-saving measures to determine its financial sustainability. Option D. Focus on the society's marketing materials and member satisfaction surveys to gauge its public perception and growth potential. Correct answer is B. Prioritize a review of the society's investment portfolio and reserve adequacy calculations to ensure compliance with statutory requirements. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a deep understanding of the specific regulatory framework governing fraternal benefit societies in the United States, particularly the National Association of Insurance Commissioners, NAIC, model laws and state-specific adaptations. A fellow must navigate the nuances of solvency, governance, and member rights as defined by these regulations, ensuring that the society operates in a manner that protects its members and maintains financial stability. Misinterpreting or misapplying these regulations can lead to significant compliance failures, financial penalties, and reputational damage. Correct approach analysis. The correct approach involves a thorough review of the Fraternal Benefit Society's financial statements, governance documents, and operational procedures against the applicable NAIC model laws and relevant state statutes. This includes verifying that the society's reserves are adequate, that its investments comply with statutory limitations, and that its governance structure adheres to the principles of member representation and fiduciary duty. Specifically, adherence to the NAIC Model Act for the Regulation of Fraternal Benefit Societies and state insurance codes ensures the society is operating in a sound financial condition and in compliance with consumer protection mandates. This proactive and comprehensive regulatory assessment is the cornerstone of best practice for maintaining a fraternal benefit society's license and member trust. Incorrect approach is analysis, an approach that focuses solely on the society's historical growth and member engagement without a rigorous examination of its financial solvency and compliance with statutory reserve requirements, is fundamentally flawed. This overlooks the primary regulatory concern: the society's ability to meet its future obligations to members. Such an approach fails to address the critical solvency requirements mandated by state insurance departments, which are designed to protect policyholders. Another incorrect approach would be to prioritize operational efficiency and cost reduction above all else, potentially by reducing staff in actuarial or compliance departments. While efficiency is desirable, it cannot come at the expense of regulatory adherence. This approach risks understaffing critical functions necessary for accurate financial reporting and compliance, thereby increasing the likelihood of regulatory violations and jeopardizing the society's financial health. Finally, an approach that relies on anecdotal evidence or informal assurances from management regarding compliance, without independent verification through audits and reviews of official financial filings, is also professionally unacceptable. Fraternal benefit societies are subject to stringent reporting requirements, and regulatory bodies expect documented proof of compliance, not mere assurances. This approach bypasses the due diligence required to ensure the society is meeting its legal and ethical obligations. Professional reasoning. Professionals in this field must adopt a systematic and evidence-based approach to regulatory compliance. This involves a continuous cycle of assessment, monitoring, and adaptation. When evaluating a fraternal benefit society, the decision-making process should begin with identifying the relevant regulatory framework, e.g., NAIC models, state statutes. This is followed by a detailed review of the society's financial health, governance, and operational practices, comparing them against these regulatory benchmarks. Any discrepancies or potential risks must be identified, and corrective actions implemented. Regular internal audits and external reviews by qualified professionals are essential to ensure ongoing compliance and to proactively address emerging regulatory challenges. The ultimate goal is to safeguard the financial security of the members and the long-term viability of the Fraternal Benefit Society. Question 13. The monitoring system demonstrates that a fraternal insurance counselor is advising a long-standing member on a new health insurance product. The member has a history of a chronic condition that has been stable for several years, and their current lifestyle is generally healthy. The counselor's initial review focuses on the product's competitive premium and its broad network of providers, but does not delve into the specific policy language regarding pre-existing conditions or the potential for increased out-of-pocket costs should the chronic condition require significant treatment. Which approach to risk assessment is most appropriate for the counselor to adopt in this situation, adhering to the principles of fraternal insurance and regulatory guidelines? Option A. Conduct a detailed review of the member's health history and current condition, cross-referencing it with the specific policies clauses on pre-existing conditions, coverage limitations, and potential out-of-pocket maximums, to ensure the product aligns with the member's ongoing health needs and financial capacity. Option B. Focus primarily on the product's general benefits and the organization's reputation for member support, assuming that any potential coverage gaps will be manageable for a loyal member. Option C. Emphasize the product's attractive low premium and extensive provider network, assuring the member that these factors generally indicate a high-quality and cost-effective health insurance solution. Option D. Rely on the member's self-reported stability of their chronic condition and their generally healthy lifestyle as sufficient indicators that the product's standard coverage will adequately address any future health needs. The correct answer is A. Conduct a detailed review of the member's health history and current condition, cross-referencing it with the specific policies clauses on pre-existing conditions, coverage limitations, and potential out-of-pocket maximums, to ensure the product aligns with the member's ongoing health needs and financial capacity. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of risk assessment in the context of health insurance products, specifically within the regulatory framework governing fraternal insurance organizations. The FICF designation implies a need for a deep understanding of ethical conduct and regulatory compliance, particularly concerning member welfare and fair representation of product risks. The core challenge lies in balancing the fraternal organization's mission with the fiduciary duty to accurately inform members about the potential downsides of a chosen health insurance product, avoiding both underestimation and overestimation of risks that could lead to misinformed decisions. The correct approach involves a comprehensive assessment of the member's health status, lifestyle, and financial capacity in relation to the specific health insurance products, coverage limitations, exclusions, and potential out-of-pocket expenses. This approach aligns with the ethical obligation to act in the best interest of the member and the regulatory requirement for accurate and transparent product disclosure. Fraternal insurance organizations, by their nature, have a heightened responsibility to their members, demanding a level of diligence that goes beyond mere transactional sales. This involves proactively identifying potential risks that a member might face under the policy and ensuring they are fully aware of these before enrollment. An incorrect approach that focuses solely on the product's premium cost without thoroughly evaluating the member's health profile and potential future claims fails to meet the duty of care. This oversight can lead to members being inadequately covered for their actual health needs, resulting in significant financial hardship and a breach of the fraternal organization's commitment to member well-being. Such an approach also risks violating regulations that mandate a thorough needs analysis and suitability assessment. Another incorrect approach that emphasizes only the most favorable aspects of the product, such as its perceived low cost or specific benefit, while downplaying or omitting potential risks like pre-existing condition clauses, high deductibles, or limited provider networks, is ethically unsound and likely violates disclosure requirements. This creates a misleading impression of the product's value and can lead to member dissatisfaction and potential legal repercussions for the organization. It fails to uphold the principle of full disclosure and informed consent. A third incorrect approach that relies on generalized risk assessment without tailoring them to the individual member's unique circumstances is also problematic. While general risk factors are important, health insurance needs are highly personal. Failing to conduct a personalized assessment means the advice provided may not be appropriate, potentially exposing the member to unforeseen financial burdens or inadequate coverage, thereby undermining the fraternal organization's core purpose of mutual support. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the member's profile. Gather detailed information about the member's health history, current health status, lifestyle, family history, and financial situation. 2. Understand the product. Thoroughly review the health insurance product's policy documents, including coverage details, limitations, exclusions, deductibles, co-payments, and network restrictions. 3. Conduct a needs analysis. Match the member's identified needs and potential risks with the product's benefits and limitations. 4. Assess risk tolerance and capacity. Evaluate the member's ability to manage potential out-of-pocket expenses and their comfort level with various risk scenarios. 5. Provide transparent disclosure. Clearly communicate all relevant information, both positive and negative, in a manner the member can understand. 6. Document the process. Maintain thorough records of the assessment, discussions, and the member's decisions. Question 14. Governance review demonstrates that the Fraternal Insurance Society's current risk management framework is largely reactive, primarily addressing issues after they have impacted financial performance. Considering the specific regulatory environment governing fraternal benefit societies in the United States, which of the following approaches best optimizes the society's response to risk and uncertainty? Option A. Increase the frequency of external financial audits to ensure that any emerging financial risks are identified and reported promptly. Option B. Delegate all risk identification and assessment responsibilities to the society's actuarial department, with minimal board oversight. Option C. Implement a comprehensive, integrated risk management program that proactively identifies, assesses, and mitigates potential risks across all operational areas, linking risk assessments directly to strategic planning and capital management. Option D. Focus on building larger contingency reserves solely based on historical financial volatility, without a forward-looking risk assessment. The correct answer is C. Implement a comprehensive, integrated risk management program that proactively identifies, assesses, and mitigates potential risks across all operational areas, linking risk assessments directly to strategic planning and capital management. Explanation: this scenario is professionally challenging because fraternal benefit societies operate under specific state insurance regulations that govern their financial solvency and member protection. The governance review highlights a potential weakness in how the society is identifying and managing risks, which directly impacts its ability to meet future obligations to its members. The core of the challenge lies in balancing the society's financial stability with its fraternal mission and member benefits, all within a strict regulatory environment. Careful judgment is required to ensure that risk management practices are not only compliant, but also robust enough to safeguard the society's long-term viability. The correct approach involves a proactive and comprehensive risk assessment process that integrates with strategic planning and operational decision-making. This approach ensures that potential threats to the society's financial health and its ability to deliver member benefits are identified, analyzed, and mitigated before they escalate. Regulatory frameworks for fraternal benefit societies, such as those found in state insurance codes, often mandate sound financial management and risk mitigation strategies. By embedding risk management into governance, the society aligns with the spirit and letter of these regulations, which aim to protect policyholders and ensure the solvency of the insurer. This proactive stance demonstrates a commitment to fiduciary responsibility and member welfare, which are paramount for a fraternal organization. An approach that focuses solely on historical financial performance without considering future uncertainties is professionally unacceptable. This failure ignores the dynamic nature of financial markets and the potential for unforeseen events, e.g., economic downturns, changes in mortality rates, regulatory shifts, to impact the society's reserves and ability to pay claims. Such an oversight could lead to a violation of solvency requirements mandated by state insurance departments, potentially resulting in regulatory sanctions. Another incorrect approach is to delegate risk assessment entirely to external auditors, without internal oversight or integration into the society's strategic decision-making. While external audits are crucial for compliance, they are typically backward-looking. The society's leadership and board have a direct responsibility to understand and manage the risks they face. Relying solely on external parties without internal engagement creates a gap in accountability and can lead to a disconnect between identified risks and the society's operational and strategic responses, potentially failing to meet the prudent person standard of care expected of fiduciaries. Finally, an approach that prioritizes short-term cost savings over robust risk management infrastructure is also professionally flawed. Investing in comprehensive risk assessment tools, qualified personnel, and ongoing training is essential for effective risk management. Cutting corners in these areas can lead to missed risks, inadequate mitigation strategies, and ultimately, greater financial instability and potential harm to members. This directly contravenes the regulatory imperative to maintain financial soundness and protect member interests. The professional decision-making process for similar situations should begin with a thorough understanding of the applicable regulatory framework. This involves identifying all relevant statutes, regulations, and guidelines pertaining to fraternal benefit societies and their risk management obligations. Next, the professional should assess the society's current risk management practices against these requirements and best practices. This assessment should involve both quantitative and qualitative analysis of potential risks. The decision-making process should then focus on developing and implementing strategies that not only address identified risks, but also align with the society's mission and long-term strategic goals, ensuring compliance and fostering member confidence. Question 15. Compliance review shows that a fraternal benefit society is considering expanding its product offerings. Which of the following accurately reflects the types of insurance products that fraternal benefit societies are generally authorized to offer under typical state regulatory frameworks? Option A. Health insurance policies for the general public, not just members. Option B. Variable universal life insurance and mutual funds. Option C. Life insurance, annuities, and disability insurance for members and their dependents. Option D. Commercial property insurance and liability insurance for businesses. The correct answer is C. Life insurance, annuities, and disability insurance for members and their dependents. Explanation. This scenario presents a professional challenge because fraternal benefit societies, while offering insurance products, operate under specific regulatory frameworks that differ from commercial insurers. A fellow in the Fraternal Insurance Counselor Program must demonstrate a nuanced understanding of these distinctions to ensure compliance and ethical product recommendations. The core of the challenge lies in accurately identifying which insurance products are permissible for a fraternal benefit society to offer, considering their unique organizational structure and purpose. The correct approach involves recognizing that fraternal benefit societies are primarily authorized to offer insurance products that align with their mission of providing for members and their beneficiaries, often with a focus on life insurance, annuities, and sometimes disability or health insurance, subject to state insurance department regulations. This approach is right because it adheres to the statutory definitions and limitations placed upon fraternal benefit societies by state insurance laws, which generally permit these entities to offer insurance for the protection and welfare of their members and their families. Recommending products outside this scope would violate regulatory mandates and potentially expose the society to compliance issues. An incorrect approach would be to assume that fraternal benefit societies can offer any insurance product that a commercial insurer can. This fails to acknowledge the specific legal and operational distinctions of fraternal benefit societies, which are often organized as nonprofits and have specific membership requirements. Recommending products such as complex investment-linked policies or specialized commercial lines of insurance without explicit statutory authorization for fraternal benefit societies would be a regulatory failure. Another incorrect approach would be to recommend products based solely on market demand or perceived profitability, without first verifying their permissibility under the society's charter and state insurance statutes. This overlooks the fiduciary duty to operate within legal boundaries and prioritize member welfare as defined by the fraternal structure. Professionals should approach such situations by first consulting the specific state insurance code governing fraternal benefit societies, their own society's bylaws and charter, and any relevant guidance from regulatory bodies. A thorough understanding of the permitted product lines is paramount before making any recommendations or offering any products. This involves a diligent review of what constitutes a benefit or insurance within the context of fraternal law, ensuring that any offering serves the core purpose of the society and its members. Question 16. System analysis indicates that a fraternal benefit society is facing pressure to increase its financial reserves and operational efficiency. As in FICF, you are tasked with developing strategic recommendations. Which of the following approaches best aligns with the core principles of fraternalism and the responsibilities of FICF? Option A. recommend a shift in investment strategy towards higher risk, higher return assets, with the primary goal of maximizing financial gains, even if it means de-emphasizing member-centric benefits. Option B. Advocate for aggressive cost-cutting measures by significantly reducing funding for member support services and community outreach programs to boost short-term profitability. Option C. Suggest rebranding the society to focus solely on its financial products, downplaying its fraternal heritage to attract a wider, less value-driven customer base. Option D. Propose strategic initiatives that integrate community service projects and member development programs with financial planning, ensuring that growth strategies enhance rather than detract from the society's fraternal mission. The correct answer is D. Propose strategic initiatives that integrate community service projects and member development programs with financial planning, ensuring that growth strategies enhance rather than detract from the society's fraternal mission. Explanation: this scenario is professionally challenging because it requires a fraternal insurance counselor fellow FICF to navigate the inherent tension between the business objectives of a fraternal benefit society and its core values. The FICF must demonstrate an understanding that while financial sustainability is crucial, it cannot come at the expense of the society's foundational principles of mutual aid, community service, and member well-being. The challenge lies in identifying and prioritizing actions that uphold both the fiduciary duty to the society and its members, and the ethical commitment to its fraternal mission. The correct approach involves prioritizing the integration of fraternal values into the strategic planning process. This is right because it directly addresses the FICF role in fostering a culture where the society's mission is not merely a marketing slogan, but a guiding operational principle. Regulatory frameworks for fraternal benefit societies, while focused on solvency and consumer protection, often implicitly or explicitly recognize the unique nature of these organizations. Ethical guidelines for FICF emphasize acting in the best interest of the society and its members, which includes preserving its fraternal identity. By advocating for strategies that align financial goals with community engagement and member support programs, the FICF upholds the spirit and letter of their professional responsibilities. An incorrect approach that focuses solely on maximizing short-term financial returns without considering the impact on member benefits or community programs fails to recognize the dual nature of a fraternal benefit society. This approach risks alienating members, undermining the society's unique selling proposition, and potentially violating the spirit of its charter and bylaws, which are rooted in fraternal principles. Such a focus could also lead to a perception of prioritizing profit over people, which is antithetical to fraternalism. Another incorrect approach that suggests reducing or eliminating member-focused initiatives in favor of purely investment-driven strategies is also flawed. This directly contradicts the core fraternal value of mutual aid and support. While prudent financial management is necessary, it should enable, not replace, society's commitment to its members' welfare and the communities it serves. This approach neglects the long-term value derived from member loyalty and engagement, which are often fostered through these very initiatives. A third incorrect approach that proposes diluting the society's fraternal identity to appeal to a broader, less value-aligned market segment misunderstands the essence of a fraternal benefit society. While growth is desirable, it should not come at the cost of the society's core identity and the commitment to its existing membership. This approach risks losing the very essence that differentiates fraternal benefit societies and could lead to a loss of member engagement and support, ultimately harming the society's long-term viability and its ability to fulfill its fraternal mission. The professional decision-making process for similar situations should involve a thorough assessment of proposed strategies against the society's mission statement, bylaws, and the ethical code governing FICF. It requires balancing financial prudence with the preservation and enhancement of fraternal values. This involves open communication with leadership, advocating for integrated approaches, and ensuring that all decisions serve the dual purpose of financial health and the fulfillment of the society's fraternal commitments. Question 17. Strategic planning requires a fraternal insurance counselor fellow FICF to assess a client's readiness for retirement savings. Given a client who expresses a moderate risk tolerance and a desire for stable, long-term growth for their retirement funds, which of the following approaches best aligns with regulatory expectations and ethical practice for an FICF when discussing individual retirement accounts? Option A, recommending a diversified portfolio of low-risk fixed-income investments within an IRA, emphasizing capital preservation and consistent, albeit modest, returns, after confirming the client understands the associated risks and benefits. Option B, suggesting an IRA heavily weighted towards aggressive growth stocks and speculative investments, highlighting the potential for high returns to accelerate retirement savings, without dwelling on the inherent volatility. Option C, proposing a simple, low-cost index fund IRA that mirrors a broad market index, without delving into the client's specific risk tolerance or financial capacity beyond their stated desire for growth. Option D, providing general information about various IRA types, traditional, Roth, and their tax implications, leaving the client to independently decide on the investment strategy and risk level. The correct answer is A, recommending a diversified portfolio of low-risk, fixed-income investments within an IRA, emphasizing capital preservation and consistent, albeit modest, returns, after confirming the client understands the associated risks and benefits. Explanation: this scenario presents a professional challenge because it requires a fraternal insurance counselor fellow FICF to navigate the complexities of individual retirement accounts ERA, while adhering strictly to the regulatory framework governing fraternal benefit societies and their financial advice. The FICF must assess the client's risk tolerance and financial situation to recommend an appropriate IRA strategy without overstepping the bounds of their licensure or the specific regulations applicable to fraternal organizations. The challenge lies in balancing the client's best interests with the fiduciary duties and compliance requirements inherent in providing financial guidance within a fraternal context. The correct approach involves a thorough risk assessment that aligns the client's stated risk tolerance and financial goals with the investment options available within the fraternal benefit society's offerings, or those permissible under relevant regulations. This approach is ethically sound and regulatorily compliant because it prioritizes the client's suitability and understanding, ensuring that any recommended IRA strategy is appropriate for their individual circumstances. It demonstrates a commitment to acting in the client's best interest, a cornerstone of professional conduct for FICF, and adheres to any specific disclosure or suitability rules that fraternal benefit societies must follow when offering or advising on retirement products. An incorrect approach that focuses solely on maximizing potential returns without a comprehensive risk assessment fails to meet the suitability standards required for retirement planning. This oversight can lead to recommendations that are too aggressive for the client's risk tolerance, potentially exposing them to unacceptable losses and violating regulatory principles that mandate advice be tailored to individual needs and risk profiles. Another incorrect approach that prioritizes simplicity and ease of administration over client-specific needs overlooks the fundamental obligation to provide personalized advice. While a simple solution might be administratively convenient, it may not be the most beneficial or appropriate for the client's unique financial situation and retirement objectives, thus failing to uphold the FICF duty of care. Finally, an approach that relies on generalized IRA information without a specific assessment of the client's risk tolerance and financial capacity is insufficient. This generic advice does not fulfill the professional responsibility to understand the client's individual circumstances and recommend a strategy that is truly suitable, potentially leading to misinformed decisions by the client. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understanding the client's financial situation, retirement goals, and risk tolerance through detailed questioning and information gathering. Second, identifying the range of IRA options available and permissible within the regulatory framework applicable to fraternal benefit societies. Third, evaluating these options against the client's profile, considering factors like investment risk, liquidity needs, and time horizon. Fourth, clearly communicating the risks and benefits of each suitable option to the client, ensuring they can make an informed decision. Finally, documenting the entire process, including the client's stated preferences and the rationale for any recommendations made. Question 18. The assessment process reveals that a long-standing fraternal insurance member, nearing retirement, expresses interest in diversifying their savings beyond their existing life insurance policies. They have a moderate risk tolerance and a desire for income generation. Which of the following approaches best aligns with the FICF fiduciary duty and regulatory obligations when advising on investment vehicles like stocks, bonds, mutual funds, and real estate? Option A. Suggest investing in a diversified portfolio of publicly traded real estate investment trusts rate, due to their potential for both income and capital appreciation, without a detailed assessment of the member's specific financial situation. Option B. Advise the member to invest in individual stocks of companies known for their strong dividend payouts, as this offers direct ownership and potential for growth. Option C. Conduct a detailed financial needs analysis, assess the member's risk tolerance and retirement income goals, and then recommend a diversified portfolio of investment vehicles, including appropriate mutual funds and potentially real estate investments, that are suitable and compliant with fraternal insurance regulations. Option D. Recommend a high-yield bond fund, as bonds are generally considered less risky than stocks and can provide consistent income, which is a common goal for individuals nearing retirement. The correct answer is C. Conduct a detailed financial needs analysis, assess the member's risk tolerance and retirement income goals, and then recommend a diversified portfolio of investment vehicles, including appropriate mutual funds and potentially real estate investments, that are suitable and compliant with fraternal insurance regulations. Explanation. The assessment process reveals a scenario where a fraternal insurance counselor fellow, FICF, must advise a member on investment vehicles. This is professionally challenging because the FICF has a fiduciary duty to act in the member's best interest, requiring a thorough understanding of the member's financial situation, risk tolerance, and objectives, as well as the characteristics and regulatory implications of various investment vehicles. The FICF must navigate potential conflicts of interest and ensure recommendations are suitable and compliant with all applicable fraternal insurance laws and regulations. The correct approach involves a comprehensive needs analysis and suitability assessment. This means the FICF must first gather detailed information about the member's financial goals, time horizon, and risk tolerance. Then, they must evaluate how different investment vehicles, such as stocks, bonds, mutual funds, and real estate, align with these individual needs. The FICF must also consider the regulatory framework governing these investments within the fraternal insurance context, ensuring that any recommended products are permissible and that the advice provided adheres to all disclosure and suitability standards. This approach prioritizes the member's well-being and regulatory compliance. An incorrect approach would be to recommend a specific investment vehicle based solely on its historical performance or perceived popularity, without a thorough understanding of the member's unique circumstances. This fails to meet the fiduciary duty and regulatory requirement for suitability. Another incorrect approach is to recommend an investment vehicle that the FICF has a personal or organizational incentive to promote, without adequately disclosing this potential conflict of interest and ensuring the recommendation is still in the member's best interest. This violates ethical standards and potentially regulatory mandates regarding conflicts of interest. Recommending an investment vehicle without understanding its regulatory status within fraternal insurance laws would also be an incorrect and potentially illegal approach, exposing both the member and the FICF to significant risk. Professionals should employ a structured decision-making process that begins with understanding the client's needs and objectives. This is followed by an objective evaluation of available investment options, considering their risk, return, liquidity, and regulatory implications. Transparency and disclosure are paramount throughout the process, especially concerning any potential conflicts of interest. Finally, the recommendation must be documented, demonstrating how it aligns with the client's profile and regulatory requirements. Question 19. The audit findings indicate a pattern of approving claims for basic medical expenses that appear to fall outside the explicit coverage limitations of the fraternal organization's hospital, surgical, and physician policies, often due to the member's expressed financial distress. As a fraternal insurance counselor fellow, FICF, you are presented with a new claim where a member has incurred significant out-of-pocket costs for a procedure that, upon initial review, seems to exceed the policy's defined benefit for physician services. The member is pleading for approval, citing severe financial hardship. What is the most ethically and regulatorily sound approach to handle this claim? Option A. Approve the claim immediately to alleviate the member's financial distress, as the organization's fraternal nature emphasizes member support. Option B. Conduct a thorough review of the medical necessity of the procedure and the specific policy language regarding physician benefits, documenting the decision based on the contract and established guidelines, and communicate the outcome clearly to the member. Option C. Deny the claim outright, citing the apparent deviation from policy limits to maintain strict adherence to underwriting principles and prevent future similar requests. Option D. Seek an informal agreement with the member to pay a portion of the claim without formal documentation, to resolve the issue quickly and maintain goodwill. The correct answer is B. Conduct a thorough review of the medical necessity of the procedure and the specific policy language regarding physician benefits, documenting the decision based on the contract and established guidelines, and communicate the outcome clearly to the member. Explanation. This scenario presents a professional challenge because it requires balancing the immediate needs of a member with the fiduciary responsibilities of the fraternal organization and adherence to its established underwriting and claims processing guidelines. The FICF professional must act with integrity and uphold the organization's commitment to fair and equitable treatment of all members, while also recognizing the potential for undue hardship. Careful judgment is required to navigate the tension between compassion and compliance. The correct approach involves a thorough review of the member's policy terms and conditions, coupled with an objective assessment of the medical necessity of the services rendered, based on the policy's coverage provisions. This approach upholds the regulatory framework by ensuring that claims are processed according to the contract and established guidelines, preventing potential adverse selection or financial strain on the organization. Ethically, it demonstrates fairness to all members by applying policy terms consistently. The FICF professional should then communicate the decision clearly and empathetically to the member, explaining the rationale based on policy provisions, and offering information on any available appeal processes or alternative coverage options if applicable. An incorrect approach would be to immediately approve the claim solely based on the member's stated financial hardship. This fails to adhere to the underwriting principles and contractual obligations of the insurance policy. It could lead to inconsistent claim payments, potentially setting a precedent that undermines the organization's financial stability and fairness to other members who have claims processed strictly according to policy terms. This approach also risks violating regulatory requirements related to fair claims handling and solvency. Another incorrect approach would be to deny the claim outright without a comprehensive review of the medical necessity and policy coverage. While adherence to policy terms is crucial, a complete denial without due diligence could be seen as a failure to act in good faith, especially if the services were medically appropriate and covered under the policy's intent. This could lead to regulatory scrutiny for unfair claims practices and damage the fraternal organization's reputation for member care. A third incorrect approach would be to bypass established claims processing procedures and seek an immediate, informal resolution without proper documentation or justification. This undermines the internal controls and audit trails necessary for regulatory compliance and financial accountability. It also creates a risk of inconsistent application of policy benefits and could be perceived as favoritism, eroding trust among the membership. The professional decision-making process in such situations should involve a systematic approach. First, understand the member's situation and request. Second, consult the relevant policy documents and organizational guidelines. Third, conduct an objective assessment of the claim against these criteria. Fourth, communicate the decision and its rationale clearly and respectfully. And finally, explore any available avenues for recourse or assistance within the established framework. Question 20. The risk matrix shows a potential privacy violation arising from the fraternal organization's plan to share member contact information and participation history with a new external vendor for targeted promotional campaigns. Which of the following actions best addresses this risk while adhering to privacy principles? Option A. Share the data with the vendor, but instruct the vendor to delete the data after the promotional campaign concludes. Option B. Proceed with sharing the data, relying on the organization's existing general privacy policy which members agreed to upon joining. Option C. Obtain explicit, opt-in consent from each member before sharing their data with the vendor, clearly outlining the purpose of the sharing and the types of data involved. Option D. Share only aggregated and anonymized member data with the vendor, assuming this eliminates privacy concerns. The correct answer is C. Obtain explicit, opt-in consent from each member before sharing their data with the vendor, clearly outlining the purpose of the sharing and the types of data involved. Explanation. The risk matrix shows a potential breach of privacy regulations due to the sharing of member data with a third-party vendor for marketing purposes. This scenario is professionally challenging because it requires balancing the fraternal organization's desire to engage its members with its legal and ethical obligations to protect sensitive personal information. The FICF designation implies a commitment to upholding the highest ethical standards and a thorough understanding of relevant laws. The correct approach involves obtaining explicit, informed consent from members before sharing their data with any third party for marketing. This aligns with the principles of data privacy, which emphasize transparency and individual control over personal information, specifically under the relevant U.S. privacy laws, such as state-specific data privacy acts and potentially federal laws like HIPAA if health information is involved. Though this scenario is more general, organizations must clearly inform individuals about what data will be collected, how it will be used, and with whom it will be shared, and then secure their affirmative consent. This approach respects member autonomy and minimizes the risk of regulatory penalties and reputational damage. An incorrect approach would be to assume implied consent or to proceed with data sharing based on past practices without re-evaluating current consent mechanisms. This fails to meet the affirmative consent requirements of modern privacy laws and disregards the ethical imperative to protect member privacy. Another incorrect approach would be to share only anonymized data without a robust anonymization process, as re-identification is often possible, leading to a potential privacy violation. Relying solely on a general privacy policy without specific opt-in mechanisms for third-party marketing also constitutes an inadequate approach, as many privacy laws require more granular consent for such activities. Professionals should approach such situations by first identifying the specific types of data involved and the intended use. They should then consult the applicable privacy laws and regulations to understand the consent requirements and data protection obligations. Developing clear, accessible consent forms and communication materials that explain data sharing practices in plain language is crucial. Regular review and updates of privacy policies and consent procedures are also essential to ensure ongoing compliance and ethical data handling.